Good evening, my name is Pavel, and today I'm going to talk to you about what really makes me passionate for many years. And I will start with a disclaimer that this presentation is for informational purposes only. This is not the investment advice. And return in the past does not guarantee that the same return will happen in the future. And that before making any financial decision, we should talk to a professional advisor and have this consultation. So, with this disclaimer in mind, let's start. And my investment journey started more than 15 years ago, and it really commenced with the help of my grandmother. She was more than 70 years old. She was a very curious lady, watching TV a lot during the day and in the evenings. And while doing this, she was watching for different economical programs there and listening to what's going on in the financial market without understanding much what's going on there in the beginning. And so, yeah, gradually she got more and more feeling into what's going on. And to my surprise, even opened a broker, an account at one of the brokers at the time. And 15 years ago, it was not as digitized as it is today. So while making these investment decisions, we had to call the broker and make all these decisions out loud via the phone. And actually, so at that time, I was more and more involved into listening. What's going on there? Like, what are these companies all about? Like, why they're growing? Why can the market go down in 2008? Why did it recover after several years? And so many years after, I'm working in a Munich-based wealth management startup, and we're helping professional advisors to make their lives of their clients and their lives easier by making data-driven decisions on a daily basis. And to begin with, I have a question, and I want to see if you're also curious what kind of audience we have here. So the question is that, how familiar are you with the world of investing? And the answer, number one, and again, there are no right answers. Please raise your hand if you're completely new to the world of investing. So it will help me to adapt my speech as well. Are there anyone? Okay, I come on sixth. Who has some basic knowledge? Okay, people. Who is moderately experienced, quite experienced, and maybe made some deals already. Okay. And who can say that he or she is very well experienced? Okay. Good. So have some experience. Okay, and now let's see how well we know it and how we work it in Germany. The next question is as follows. According to the most recent statistics, what percentage of the population in Germany aged 14 and older is actively present on the stock market? So it means investing into stocks or funds or bonds or other asset types. So who thinks it's 17%? And there is just one correct answer. Please raise your hand. Yeah, higher. Okay. 27. 37. You want it? Okay. 47. And the correct answer, so I would say the minimum amount of people guessed it correctly, is actually only 17. And in comparison, in the United States, this share is 61%. So there is still a long way to go there, which would also imply that there is a necessity to learn, to invest time into the world of investing and understand what's going on there. So, what's going on there? Let's start with the most important question, and it is, why actually people want to start investing. So what the reasons are, and there are several key reasons. The first one is reaching financial goals. It means that before opening an account, selecting for stocks or bonds or something else, you need to really think of your finance to see and calculate what the current situation is, what the plans are, what you're going to do with this money in 1, 3, 5, 15, 35 years. And then another reason to start investing is actually prepare for retirement. And the earlier you start doing this, the more time you have and the more return you can receive in the long run. So here, what's important is the compounding effect. We'll go to this a bit later, and for those who don't know what compounding effect is, I will explain it. But it means that the earlier you start investing, the earlier you start generating wealth. This compound interest will help to speed this process up in the long term. And last but not least, it's a way to diversify income streams, which means if you can generate additional wealth by investing into some stocks or bonds and getting coupons from bonds, getting dividends from stocks which pay these dividends, and also benefit from your assets going up. Then, another important thing is to understand what are the key asset classes out there on the market. And this is something that is also necessary to actually select your portfolio and to understand how to balance it, how to amend the decisions, and what's going on the market, how your portfolio is feeling, and so on and so forth. And to start with, these are the cash accounts and cash equivalents. So these are just, for example, the basic bank accounts that you have and some money that you have out there. They can generate a bit of interest per year, but in some banks, money is just laying there flat without any movement. Then there is so-called fixed income. For example, it can be a fixed deposit which generates a bit more percentage per year compared to the asset class number one. Or, for example, coupons from bonds that other governments or corporates pay you for you lending money to them. So this is also a way to generate wealth. Then there are some equities. And by equities, we can understand, for example, stocks or funds or some other asset types that you buy, for example, some stock with the intention that its price will raise, or you buy a so-called fund which can comprise of different assets inside. So, for example, an actively traded fund can allocate money in some specific markets, in some specific countries, in some specific industries. And by doing this research, you try to predict together with the market what kind of industries, countries, and market will grow in the long run. Then there is real estate. It can be personal, it can be professional. Like, for example, you buy a flat with the intention to rent it, generate some income every month, or you buy residential industrial building and rent it to companies, also with the intention that these companies will rent it and pay you every month, and over time the prices will go up. So this is how you will possibly generate additional wealth by investing in the real estate market. And last but not least, there is so-called alternative investment. It's also a way to diversify the portfolio, but here the problem is with liquidity. And liquidity is something that shows how easily some asset can be traded with real money. So if you have a piece of art, a painting, for example, it can worth a lot of money, but how easy is it to really exchange it with real money? That's the question. So that's why it's important to understand. And also by doing this, there is the so-called ratio between the risk and return. And the rule of thumb is that the higher the risk is, the higher the possible return is, and vice versa. The lower the risk, the lower the return. So, as we started with cash is a fixed income, this implies that these are some defensive assets, which means that they're not really prone to a lot of fluctuation over time. So it means that what you have there, you can pretty easily predict how much money or how much wealth you will have over some specific amount of time. But for example, stocks, on the opposite, can really fluctuate a lot. They can go up 40%, they can go down 80%. So that's why the strategy is super important, so that you can decide on what kind of assets you want to invest in and whether you're ready to wait for such raises or falls in your portfolio. And also, what's important here is the risk tolerance and some of the factors that can affect it are the investor's age, their capacity to recover from financial loss or financial goals in short, medium, and long terms. Then I touched upon the concept of the so-called compound effect and compound interest. And for those who don't know, here's how it looks like. So basically, if I would have explained it to a child, I would say that imagine that the compound interest is like a tree, or let's say like a fruit. So you have a fruit, and you can use this fruit to plant it in the soil. And this fruit eventually will become a tree. And the tree will give you more fruits. The more fruits you have, the more trees you can plant with these fruits. And so on and so forth. You can have a lot of harvest and a lot of fruits eventually. So this is how the compound interest works on the financial market. The money that you invest is called the principal. So here, initial principal. The money you generate by investing it with some interest is called the accumulated interest. And by combining these two over time, year after year, the return that you have is going to accelerate. So, for example, if you invest 1,000 euro for 4 years for 10% per year without withdrawing this money, how much will you have? So, after year 1, you will have your initial 1,000 and 100 extra euros. So, it will be 1,100 euros. If you keep this money in the account, let it grow, by the end of year 2, you will have not 100, but 110. And this will be reinvested. Then, in the beginning of year 3, you will have 1,210 euros invested by 10% per year. And again, at the end of the year, you will have more than you had in year 1, year 2, and in year 3. And so on and so forth, that eventually, over time, this money will grow faster than it happened before. And to show a more vivid image of how it can look like, here are the four examples, again with the disclaimer that you see here, 4 scenarios. So scenario number 1, imagine that you have 5,000 euros as an initial deposit. You put it in the bank account, it does not generate any interest, so it's just there, just 5,000. And year after year, you want to add, month after month, you want to add 100 euros there and see what's going on to happen in 30 years. With the example, not euro, but dollars. So in 30 years, this $5,000 will become $41,000 in today's prices with today. In today's prices, so it does not account for inflation. So in 30 years, this is what we'll have. Imagine you do the same, but you select, for example, a bank account with an interest rate of 4% per year. This is what we'll have potentially 2 times more than in the first scenario, because again, of this compounding interest that will help you to generate more and more and more money month after month. Then, example number 3 is for the so-called S&P 500. So this is the index that combines together 500 most valuable companies in the United States, which grew on average by 7% per year in the last 50 years. So if an investor would have invested it, instead of having 80,000, it would be 181,000 in 30 years. And imagine situation number 4, scenario number 4, if an investor did the same, but investing in this index of 500 most valuable American companies with dividends reinvested. It means that when companies generate some profit, they share it with investors. And you can either keep it or continue investing this money in buying more and more and more of such indexes. And on average, in the last 50 years, the return per year was 10.5%. And that would result in 366,000. So this is actually how compounding interest works. And properly selecting all these asset types is super, super important to consider what your strategy will be for your time. And the two main strategies that investors can have on the market are called diversification and concentration. And the difference between them are the following. So when you diversify your assets, it means that you can select different companies, different markets, different countries, different sectors, and invest there. So if somebody believes that artificial intelligence is going to thrive, then it means, for example, that companies working there will also continue to thrive. And it might be an interesting idea for an investor with a specific risk level to invest there. Or if some countries are going to grow, you invest there as well. And in this case, one of the advantages is that the risk level is a bit lower because you don't concentrate your assets in some specific area or company, but rather diversify into those different ones that I've mentioned. And thus, for example, if one company goes bankrupt out of 20, it might not influence the portfolio as much as if you have concentrated everything in this just one single company. The disadvantage there is that potentially the return can be lower, and that while choosing these funds and while choosing this kind of assets, the investor still needs to properly do the research in advance to make this decision and to know in advance what kind of market he or she thinks will give the best return over time. Then there is the strategy of concentration, and on the opposite, it's when you are selecting some limited amount of assets, limited amount of markets, with the intention that this particular choices will generate more wealth rather than diversifying it into several specific markets. Here, the risk is really higher, and if you look into the statistics, as far as I remember, it's just several percentage of actively traded funds who manage to outperform the overall market, which makes it a really, really tough job to select these assets and to properly think what can drive this wealth more than when the market is growing on average. And here are the key takeaways for these ideas. So again, diversification can help you to select a broad range of assets rather than concentrating your money in a limited amount of choices, with the intention that this limited amount of choices will generate more wealth rather than selecting a diversified portfolio. And while listening to all of this, you might wonder what steps you need to undertake to make it happen if you have never invested because it may sound complex, and it actually is complex. I wouldn't say it's easy. It's pretty hard to do all this research and to understand how to select your first portfolio. And step number one is to really sit down and summarize what your financial goals are. So what do you want to achieve and when? In the midterm, in the middle term, in the long run, in a year, in 20 years, or when you retire. Then understand the risk tolerance. Are you ready to invest in something and lose everything? And if not, why not select some other assets which may generate lower return, but still will not be as risky and will not fluctuate as much as more riskier items? Then educate yourself. So start reading, start looking for some inspiration, start listening to financial programs, read magazines on financial markets, and research papers and so on and so forth. So go there and educate yourself. And only after that, it may be a good idea to start with a demo account. You are not risking anything if you open a demo account, so you can play around and see what would have happened if you invested in something, but without risking your real money. And only when you feel confident enough and comfortable enough, open a real broker account. And when you do this, start with a low risk, low amount portfolio, and eventually and gradually grow it as you feel more confident. Then, one of the most interesting things that's happening now, and it's one of the trends that we're going to talk about briefly, is the power of AI. So different technology, different AI tools help to select this asset, help to educate yourself, help to explain what's going on the market, and make these predictions, and actually make the life of an investor easier. And also regularly review the portfolio, see what's happening on the market, and buy some more assets, sell some more assets, and rebalance the portfolio. And of course, seek financial advice if you're not confident enough. And here, step number 7 is an important one, and I will show you why. So this a bit complicated graph will be easier for you to understand when I explain what's this. So these are the average returns in the last 10 years of different asset classes. And it is ranked year after year based on the return. On the top, you will see those asset classes which generated more return per year in some percentage. In the bottom, you will see some that resulted in the losses for investors. And for example, if you look at year 2017, and if you invested in China equities, that would have resulted in more than 54% of average return per year. But imagine if you would not have done anything with it and just keep it there, next year that would have been the worst asset class to invest in. And the same picture happened in a couple of years, between years 2020 and 2021. Again, China equities on top, China equities in the bottom. Some other example is, for instance, 2021-22, commodities were the top asset class. Year 2023, nothing really happened during the whole year. Average return, 0%. So that's why following the news, looking into what's going on, understanding all this is super vital. And checking what's going on there is important. What can help here? And what is really trend that is there during the last couple of years? So you hear about AI on a daily basis, and WealthTech and wealth management sphere is also a sphere where AI really touched all the corners. And what can AI help you with there is, for instance, develop personalized investment strategies. So think of the first investment portfolio, think of how it can look like, think of what shares can be there, and how can all these asset classes be divided based on your risk. Then analyze the markets, understand what's happening there, what investors think, what analysts think, what predictions companies make, and what will happen with the economy in general. Then, building automated portfolios with advisors is also something that's really happening now. So you just talk to an online broker, to a chatbot, answer some questions, and then these robo-advisors can help to make automated investment decisions on some regular basis and adapt and optimize the portfolio based on the market situation, on what's happening there, on what kind of fraction of the portfolio is invested in different countries or asset classes or industries. And last but not least, which is also important, is to understand what the sentiment of the market is. Because it's not only important to understand what companies will think of their performance in the future, but also what analysts think of this, what markets think of this. So this is called the sentiment, and this is also something that really can make a difference in how different markets behave over time. To sum all this up, again, the key takeaways. So this is something which we discussed in my monologue in the last 20 minutes. So we talked about the reasons to start investing. We talked about different asset classes. We talked about the risk and return ratio and why is it important for an investor. Then we looked at the compounding effect and why is it important in the long run and how we can make the portfolio stronger and stronger over time. Then the so-called, then the diversification and concentration strategies and why they can suit some investors and don't suit others, depending on their strategy. Then some of the first steps to build an investment portfolio based on the ideas of the market and how these ideas actually can change year after year. And last but not least, some AI trends of the WealthTech market and how AI can help to make these financial decisions and help you to become a better investor. Thank you very much. For those who want to connect with my LinkedIn, feel free to reach out to me, ask questions, and let's build portfolios together.
Thank you, Pavel. And the question is whether you have any questions. Yes, I can see a hand in the air, another hand in the air.
Well, thank you for the inspiring presentation. I wanted to ask what do you think about another kind of money, I mean kind of Bitcoin investment.
If we go back to this risk-return ratio, so it's there. I would say it's somewhere like this, in this sphere. So again, this is an interesting sphere that has been developing. This is something that many people, not all, think will replace traditional finance. So this Web3 will be something decentralized, managed by the investors, managed by the developers, but it's still in the very beginning of its journey. So there is still a lot of steps need to be done to gain more trust there. But overall, this is a very interesting concept. This is a very interesting sphere where projects appear every day, where there are plenty of possibilities to learn. And actually, that's what I'm doing myself, exploring the world of blockchain, understanding how these decentralized finance work and what that actually is. Because even though it might sound complicated, there are many similarities between this world and the world of traditional finance. And also that's why it's on the one hand easier, but on the other harder, because if you want to invest there, you need to select projects properly. You need to do the due diligence in advance. You need to do the research. You need to understand what is the project about, what is the company doing, what are their plans, who is the team, and so on and so forth. Because otherwise, the fluctuations can be much higher than the traditional financial market, and there is a higher risk involved there.
Yeah.
Well, this is not a question, but I just want to give some comments. Is it okay?
Sure.
Yeah. So instead of S&P 500, there are still many companies that not performing well. So sometimes diversification is not always good. And in the past, I used to invest QQQ, which is the Nasdaq 100 companies. But then these days, I realized that the market cap ranking number one, the biggest company is the most a safe company. And because when the economy is got real kind of bad, and the market cap ranking one, the biggest company, the largest company, falls a little little than the other companies. And the market cap ranking number one, the largest companies usually have the best credit rating. And if the government's prints out the money, then the investments usually go to the largest company. I think it's the principle of capitalism, and the monies usually go to the big companies. And then I see when the company doesn't perform well, then the market cap ranking falls down. That means it's kind of time to sell. So I usually care about the market cap rankings. Yeah. Particularly US stock. I don't invest in other countries. Yeah. Yeah. So that's just my comment. And it's more profitable than S&P 500. Yeah.
And again, as I mentioned briefly, every investor in this room is supposed to have a different strategy. So what works for you will not work for everyone. So that's why there is this professional advisor. That's why there is a wealth manager, because every person has a different risk and ratio portfolio.
Yeah, investing one or two stocks can be scary at first. Yeah, but this is what I realized. And the bigger companies are being more safe. And that's what I stopped.
And it also goes hand in hand with what was mentioned here. So when investing in just a couple of companies, it's important to see, first of all, the earning calls. So these are the quarterly events where the management talks about how the company is feeling, how did it behave in the past, if it sort of performed in the past, where the plans are, what the intentions are. And then look at the sentiment on the market, how happy investors are with it. Because the targets may go up, but the investors might think, oh, that's not encouraging enough, and can start selling. So that's why this concentration strategy might, on the one hand, potentially generate high results, but on the other, might be much riskier for an individual investor.